Hello and welcome back to the Energy Flux podcast. I'm your host, Seb Kennedy, founding editor of Energy Flux. I'm here by beautiful Regent's Canal in central London, filming by one of my favourite buildings in London, which are the old converted Gasometer buildings, which you can see behind me there. They were old town gas storage facilities which were converted into housing several years ago, and they just make for just the most wonderful kind of mix of architecture and energy infrastructure. So I'm going to give you a little tour of this really beautiful part of London on this spectacular winter's day, while I reflect a little bit on some of the themes from 2025 in the world of energy, gas and liquefied natural gas markets. And I have another listener question which seems very timely to address. So I might start with that actually, because I put out a video reel on LinkedIn earlier this week before appearing at a speaker panel of thought leaders invited by the Global Renewables Alliance to discuss the energy transition. I gave a kind of slightly alternative perspective to the renewables folks who were gathered there, just to explain to them the importance of gas pricing and gas markets when trying to understand the energy transition, the trajectory, the pace of investment, and also the kind of mentality, the mindset of policymakers as the markets evolve from the kind of crisis period into the new regime that's about to unfold, which I'll talk about. And in that video and in the event where I then subsequently spoke, I was talking about exactly that, the cheap gas, this new pricing regime that's coming with the glut of LNG, which is going to depress hub prices and make gas cheaper, make power cheaper in gas and LNG importing regions around the world. That's going to fundamentally change the entire outlook, I would say, for the rest of this decade. I think that the second half of this decade is going to look very different to the first. The energy crisis and scarcity pricing, that's all going into the rearview mirror fairly quickly, notwithstanding a kind of last winter spike in prices, which is kind of to be expected at this time of year as the cold weather bites. But the kind of macro trend is definitely downwards towards softer market pricing, lower spreads on the spark spread, and lower returns for storage facilities. I think that this is a challenge for the energy transition, because it really makes many investments more difficult in the energy transition space. If gas is cheap for those reasons, a heat pump becomes less cost effective compared to heating your home with gas, and electrification becomes less urgent a priority if sticking with gas is so much easier and straightforward and doesn't require upfront capital investment. But I had a question from Ben in London, who asked me, let me call up his question here. So, Seb, is there a counterfactual that suggests that falling marginal price of gas floats all boats, i.e. making the clean energy transition easier in the UK, or is that wishful thinking? And I mean, it's not wrong to imagine that, because there will be kind of edge cases where having cheaper gas and cheaper electricity will improve uptake of energy transition technologies and decarbonisation. So having cheaper electricity, it probably does assist with electrification in the kind of broadest general sense, because if electricity is cheaper, the cost of running an electric vehicle, for example, becomes cheaper. But I think those are really edge cases, because it's competing against diesel and gasoline, petrol, rather than against natural gas, because we don't really have gas-powered cars in use in Europe very broadly. But there's this other question around mindset, which I touched on earlier, which is that the policymakers, there are so many crises wherever you look. transatlantic relationships with the Trump administration, which are extremely fraught at the moment, particularly regarding the question of a Ukraine peace settlement, which is supposedly moving forwards and approaching something resembling a conclusion, but it's very hard to see that in reality as the drones and missiles keep raining down, and there was really no budge in the overall positioning of either side in that conflict. So this idea that, you know, kind of energy is an urgent priority, that we have to subsidize bills, that we have to somehow keep factories from shuttering their doors because energy costs are too high, those concerns are drifting away, and I think you're going to see this kind of mindset shift to a place where other priorities have space, because European economies have really been absolutely hammered by the energy crisis, and their policymakers have just been completely unable to think about anything else. Those concerns are going to kind of take a back seat, and that's a problem, because obviously, you know, the energy security and reliability and availability questions that were raised by the gas crisis, and that spurred things like kind of doubling down on renewables, on demand replacement of natural gas, on technologies that can push gas out of end-use applications. Those incentives are going to be dulled. They're going to be replaced by a sense of, well, you know, the energy thing is fixed now. You know, the energy crisis is kind of fixed. We've got a few years. We can think about other things. We can think about migration. We can think about the rise of the far right in Western democracies. We can think about questions around, you know, social mobility, or the pernicious influence of mobile phones on the health and mental well-being of our young people, or we can think about all a myriad of kind of socio-economic issues that have really had to take second place during this really very kind of fraught few years. So, you know, it's hard for things like industrialization of the steel sector, or how to drive grey hydrogen out of refining with green hydrogen, or pushing to get that next 30-40% of the residual load decarbonised on power grids that are already kind of struggling to accommodate extra intermittent or non-dispatchable renewable resources. Like these things just seem like kind of like they're difficult. You have to kind of confront a lot of vested interests. There's a lot of infrastructure and technological resistance to achieving those. And when they're not an urgent priority, then they just kind of slip down the list of priorities, I'd say, in the way that they get treated. So it's this kind of perennial problem of, well, how do you fix the roof when the sun is shining? And that was the actual line I used when I spoke to the Global Renewables Alliance, and that got me thinking, well, if adversity is the mother of invention, then what is abundance? And I think that abundance is really the father of sort of path dependency. So to elaborate on that sense a bit, well, if you have abundance, then there's no real need to change path, because everything's going well and everything's fine. You know, if it ain't broke, don't fix it, as they say. So that's going to be a real challenge for those who are advocating for kind of swift energy transition progress in the next 5 years or so. Now, all of this kind of philosophy, if you like, it's all predicated on the idea that there will be cheaper gas prices, and there will be. That's a definite. But what's less clear, even at this stage, is, well, just how cheap will gas go? How much more affordable will power become as a result of the marginal gas generator becoming less expensive? And for how long? Basically, how long and how deep will the LNG glut be? That is very much an open question. And there are lots of kind of self-correcting market mechanisms that could ensure that the glut is perhaps not as deep as some people might think, and it lasts much less time. I mean, the number of gas and LNG industry executives who are quite blasé about this is pretty surprising. there's a very common view out there that there won't really be a glut at all. Still, even now, one of the reasons for that is that we're going to see fewer LNG projects built than many people really think. And the reason I say that is because we've already seen one large project, it's called the Lake Charles LNG project in Louisiana, that's been cancelled. The company that was developing it, Energy Transfer, they're like a very big energy infrastructure developer. They scrapped it. They basically said, look, we're not going to build this LNG project in Louisiana. The return on investment is just not there. It's not adequate. It's like, there's no point putting our capital into that. There are other projects, other places where there's a better return on investment. And they actually named natural gas pipeline projects that they have under development in the lower 48 states of America. And I think that is just such a telling development. It's really significant, because the whole kind of investment thesis in the gas world is being turned on its head. It always used to be the case that gas pipelines were really quite a boring investment. It's just like point-to-point distribution, midstream revenue. They're kind of low risk, low return, almost like utility style paybacks. It's not exciting place to put your capital, but it's like kind of guaranteed growth sector if you want that kind of risk profile. Whereas like an LNG project where you've got global arbitrage opportunities, you've got a Henry Hub cost-based gas, which is very cheap, and you're selling it into extremely expensive, premium-priced markets in Europe and Asia. There's hundreds of millions of dollars potentially of margin to be made on shipping liquefied natural gas that's produced at that low-cost base into those markets. And I think Energy Transfer is realizing that story of like massive margins to be made on LNG projects, it's just starting to fall apart a little bit. Now, don't get me wrong, there's still a lot of money to be made in LNG right now, shipping Henry Hub gas into Europe, but much less than there was. And the outlook, which is the most important thing, which is like, where is it going to be in the future when a lot of these projects that are still under development actually come online? Then the question is, well, where will margins be then at that time? And that's the really tricky question to answer, because the futures markets are pricing in further compression of spreads between the US Gulf Coast and Europe and Asia, which I've talked about many times, both on this podcast and other industry events. So that's really is, I think, weighing on minds. And Energy Transfer, they can see the writing on the wall, really. I think they understand that, the amount they can expect to make from it is going to be much lower than when they perhaps started the development phase of this project. Plus, the other aspect of this is that they would have to pre-sell the LNG into the market before they can take a final investment decision and get bank finance to cover the construction costs. And the bank asks, the bank requires that kind of revenue certainty. So you have to pre-sell up to sort of around about 80% is the target. So 80% of your production volume needs to be pre-sold under firm, binding, almost gold-plated sales and purchase agreements that binds the buyer to and makes them commit to paying for those volumes, whether they use them or not. And that's a really, really hard thing to do when all the buyers, all the big gas buyers around the world, they can see what everyone else can see, which is that the spot market is going to get very cheap. So why do you need to tether yourself to a 15 or 20-year sales and purchase agreement when you can just dip into the spot market and get cheap gas without the commitment? So I think Energy Transfer and many other LNG projects are going to run up against that reality, which is that, why would buyers commit and underwrite more liquefaction capacity when there's already arguably going to be too much? So that's that kind of attrition of projects, the failure of projects to be developed. That's going to kind of potentially crimp off the end of the LNG glut, maybe make the glut a little bit less long, less deep, if projects that are scheduled to come online around 29, 2030, 2031 don't actually materialize. So that could affect the overall kind of arc of this abundant, cheap energy price place that I think we're going to head to as we face the second half of this decade. So bringing it back to the question about, well, does cheap energy really spell bad news for renewables? Well, I think if policymakers have learned anything from the last sort of 4 or 5 years, it's that this sector, the gas sector, which is so important to the benchmarking of energy transition investments, if they've learned one thing about the gas sector, it's that it is incredibly volatile. The one thing you want to be afraid of is kind of consensus in this space, because the minute there's a consensus, then the market goes and proves everybody wrong. So this kind of consensus that we're going to have a glut is going to be very long, going to be very deep. I mean, I find it very compelling, but I do worry in the back of my mind that it becomes a bit too much of a mantra that doesn't get questioned. And I'm going to have to keep on my own toes and always reassess my own assumptions about where this trajectory is really heading, because if it changes, it can change dramatically, and it can catch a lot of people by surprise. Obviously, Russia's invasion of Ukraine, that was a total black swan event, but you never know what's around the corner. The potential for these markets to whipsaw from feast to famine and back again is really unlike anything it's ever been in the past. So there's a kind of word of warning around that. The next crisis is never that far away. We might have 5 years or more of cheap energy, but the gas industry itself is already saying there's going to be a shortage of liquefied natural gas, that they see demand continue to rise, and nobody wants to invest in LNG infrastructure. Well, they won't want to once this current clutch of projects comes online, because the returns will be much lower than many people anticipated. So there'll be this kind of go from a structural surplus to a structural deficit in the early 2030s. Of course, they are saying that because they want to tell the story to get more investment into the supply side. But the argument that they are making is implicitly saying that you really need to get off gas demand. You need to lower gas demand, lower gas dependency, because its pendulum is only going to keep swinging from feast to famine. And so the urgent need to fix that roof while the sun is shining is more urgent than ever. And if we spend 5 years without thinking kind of strategically about the next phase, the next decade, particularly in like resource scarce parts of the world, like Northwest Europe, that is extremely dependent upon imports, if this region doesn't grasp the nettle on energy security while it can afford to, and change the kind of strategic positioning of key economic sectors to dial down that import reliance, then they will come to regret it when that pendulum does swing and the gas industry's own warnings of a deficit come true in the 2030s. So the next phase of this market might invite complacency, but it will punish complacency at the same time. So that's really the paradox that we are facing at the end of this tumultuous year in energy. Anyway, I'm going to wrap it up here. A final look at these glorious old converted gasometers. They really are quite the sight in this spectacular winter sun. I hope you enjoyed the tour. I hope you've enjoyed reading Energy Flux. If indeed you do, if you don't, then you can fix that. Go to www.energyflux.news, sign up for the free newsletter, check out the deep dives, the chart deck. It's the place where I analyse gas markets in forensic detail. And there's a huge amount of value there in front of the paywall and even more behind it for paid subscribers. So if you want to get a handle on gas markets, Energy Flux is the place to do it. It's truly independent newsletter, no advertising, no corporate sponsors. It's honest, unfiltered data and debate and grounded opinions about this fascinating market that is just so central to the entire global economy, really. And I think that this space really needs an independent voice. So if you support the project, you support this concept, then I would invite you to tell your friends and family and your colleagues about it. Sign up to Energy Flux, and if you can afford to, then take out a subscription to support the publication. A huge, huge thank you to everybody who has listened, who has read, who has shared, who's engaged, who's asked questions. A big thank you to the data providers who I frequently quote in the newsletter, without whom it wouldn't be possible to undertake a lot of my analysis. They are Kepler and Spark Commodities. They are fantastic data providers, so I do appreciate having access to those invaluable resources. And to everybody that has shared quotes with me on the record, off the record, background briefings, who have challenged me, have asked questions, made me change my own view of things as well. This is such a fast-moving space that you can't be too wedded to your ideologies. You've got to keep asking the question about where are we really going, and the answer is always different. So that's why I'm going to keep doing this. I'm going to keep producing the podcast. I'm going to keep writing the newsletter. I'm going to keep engaging with people to figure this market out. So thank you again. Have a wonderful Christmas and New Year, and I'll see you in 2026.